Chapter 5 is kind of important chapter because you might have a lot of clients doing this itemized deduction. However, compared to a few years ago, before 2018, it was much more common, but the standard deduction has been increased, almost doubled, and because of that, less people will end up doing itemized deduction for their taxes. So I will try to do as much as we can and maybe look at the Schedule A that to see how it looks like right now, and hopefully we learn as much as we can. So let's keep going. The learning objectives is obviously standard deduction comparing to itemized deduction. Standard deduction is a limit that you can deduct, everyone can use, but if you have a property, mortgage, interest, property tax, let's say medical, big, huge medical expenses, in that situation, you might want to do itemized deduction. Your software will normally do uses the highest one. You don't need to force it unless you want to force itemized deduction. Then you have to check the box to force the software to use itemized deduction. Other than that, the software will decide which one is best for you. So in an itemized deduction, we're gonna go and see what's inside in Schedule A. Here is a picture of Schedule A from top to bottom. So let's just look at it before we continue. As you see in Schedule A, you have the taxpayer name at the top with the social security number of the taxpayer. And then we have the medical expenses. Medical expenses in some years might be 10%, but for last, I believe last 2-3 years, it's back to 7.5% over AGI. So your medical expenses should be 7.5% above AGI in order to be useful in your itemized deduction. So hopefully never ever you have a client to use medical expenses. That means they have a lot of medical issues. So hopefully you never use it. But in order to use it, if they, normally they look good, healthy, and they have a little bit of medical expenses, they show it to you, normally it's not gonna be used most cases because it's hard to get to that above 7.5% of AGI. So if you have $100,000 AGI, your medical expenses should be more than $7,500 in order to be something in box 4 on the right-hand side. Includes all medical expenses, dental expenses, vision, glasses. Is not including Tylenol or over-the-counter type of medications, but only prescribed medications. And if you look at the second part, it shows you the taxes you pay. So line 5 says state and local taxes, which includes A, state and local income tax or general sales tax, whichever is better. So you have to choose. You may include either income tax or general sales tax on line 5A, but not both. If you elect to include general sales tax instead of income tax, check this box. So there is a box in the software that if you check that, you force to use general sales tax. If not, then if you paid a lot of income taxes, maybe income taxes are better. General sales tax has a specific calculation. The software will do it for you based on a specific table. It's an amount, but if local income taxes are higher, then you will use probably that. So you have to choose. State and local real estate taxes, that is property tax that you pay. That's why I say you have to have a home in order to be kind of qualified for itemized deduction. That's one reason. Real estate tax goes in 5B. State and local personal property tax goes in 5C, which is your, let's say you have a camper, RV, or a boat. You pay property tax, personal property tax for those. That goes in 5C. Then in D, you add them up and enter smaller of 10,000 or whichever is smaller, smaller of 10,000 or the other one. So maximum is 10,000 bottom line. And the reason it happened is after 2018, they put this cap. So states like California that they pay a lot of income tax, state income tax, those taxpayers, they get hurt because of that one line that you see here. Before that didn't exist in 2017, let's say, or 16 or 15, that was not there. So since 2018, after Trump Job and Tax Act, they came up with that 10,000, which hurts states like California, which are not kind of, Republican states that much.
If you purchase a car, would that go into that? The taxes that you pay on the car?
Yeah, the sales tax, yes.
That will go into sales tax.
State, local, personal property tax, sales, yes. Let's say you, in 1 year, you purchased a very nice car, $60,000, and you pay, let's say $6,000 property, sales tax. That sales tax by itself, it's a big sales tax. So you put that sales tax there and you combine that sales tax that you paid extra with the general sales tax that you need to have. So all of a sudden your sales tax will be higher than your local income tax. So in those years that you have a brand new big item and you pay sales tax, those are probably years that you might try to check this box and use general sales tax instead of local income tax. If there is any other type of taxes, it goes in line 6. That's why they left it open, so you can itemize them and create some lines and put something over there. Okay. In line 8, you see this category is interest you pay. So home mortgage interest or points. If you didn't use all of your home mortgage loans to buy, build, or improve your home, see instructions and check this box. So this home mortgage has a limit. I think it's $750,000 right now. That's the mortgage limit. If you have a very expensive house, so your mortgage is above that, just the portion that it's up to 750, I believe it's usable. Any additional mortgage interest that you are paying is not going to be used. If you have home mortgage interest and points reported to you on Form 1098, which normally you have that will go in 8A. Home mortgage interest not reported to you, then it says it goes in B, and you have to put line items and report what it is and what's coming from. And charity goes in line 11 through 14. Normally, the charities that you have, it's going to be either cash payment, so you have to have a receipt for it. If it is just donation, again, the donation has a receipt, and you have to estimate how much it will cost. So up to $100, it's fine, but more than that, you have It says you must attach a form and go more details on that. Casualty and theft losses, it's not allowed overall after 2018, unless it is declared as disaster area. Like if you look at those areas that has been or have been impacted by tornadoes and hurricanes and those type of things, flooding, it will be declared by the IRS, and then you can use casualty and theft losses for those. And other itemized deduction are things that you can line them up. Depends on what it is, name them, and then put them in itemized deduction. Before it was a section that I don't see it here right now. It was other item, miscellaneous itemized deduction subject to 2% AGI, which right now as till 2025, between 2018 and 2025, it's gone. So we don't have it anymore. So it's a little bit simpler kind of itemized deduction. Let's go to the book, see what we can do with it. So here is reporting itemized deduction. Looks like we have an example here that you can look at it. Those are things that it's happening with a client, and you have to kind of distribute this information into the Schedule A. So if there is a picture, maybe I can look at it. Yeah, so it looks like here we have medical and dental expenses of $16,952. But the AGI is looks like $374,000. So that's a lot of AGI. 7.5% of AGI is $28,000. So even with $16,000 medical expenses, nothing goes on the box 4 because it's less than 7.5% of AGI. Here we have $13,050 for state and local income taxes or general sales taxes, whichever is bigger, you can use that. You can try to see which one gets bigger, okay? Try option income tax, or check the box and use general sales tax to see which one is better. So you can try. So if we go back to the previous page, it says state and local income taxes, $13,050. So that's what we're gonna use. Real estate tax, $10,000. Local personal property tax, let's say for a boat or RV, property tax that you pay annual basis, that's $667. Add them up, so 13,000 plus 10 plus 667, that's $24,000. But for a person in California, that's normal, right? But the point is, you cannot go over $10,000. Therefore, the $10,000 will be chosen. So all of a sudden, you lost a lot of things that you probably could itemize it, but that one line is blocking you. So that's why using itemized deduction has been decreased significantly. One reason is standard deduction increased twice. And other reason is that one line over there is blocking people from using itemized deduction, specifically people with higher income. Interest you paid on home mortgage, it goes in here, $16,435. Again, up to $750,000 of mortgage, I believe. If it's more than that, you cannot put all your mortgage interest in here, remember. And let's see, investment interest. Investment interest here is because you borrow some money and you put in the investment and you have some dividend income, interest income, whatever type of investment income you have, but that interest that you pay for that borrowing by itself, it will be a deductible item on line 9. 21,892 combined, 16,000 plus 5,000. Charitable contribution, if there is any check or cash, you have to put the amount over there. And other than by cash or check, it is $250. You have to fill out that Form 8232 and put the details about that in that form and put that amount over there. The charitable contribution is subject to your AGI, depends on what type of contribution it is. You cannot, in the best scenario, you cannot contribute, use charitable contribution more than 60% of your AGI in a year. So you might contribute a lot to charity, but that's up to, at the best scenario, up to 60% of your AGI. Yes.
What is the carryover from prior year? What could that be?
Carryover, let's say, I just said, you remember I said up to 60% of your AGI, you can put charitable contribution. How about you did contribution more than that? So the remaining that you can't use this year, you can carry over up to 5 years to the next year. And what is it? So here is the charitable contribution, 8,000, and then you add them up. That's 39,962. Because this 39,000 is bigger than 25,000 merit filing jointly standard deduction, obviously you're going to use itemized deduction. So this is a very good kind of picture to see what's going on. Medical dental expenses, as I said, normally is like doctor, fees, glasses, prescriptions, nothing over the counter. Yes. Implants, yeah, dental, everything dental. Yeah, everything dental included. Yeah,
It's only the amount you pay, like if your insurance pays.
No, what you pay from your pocket. Yes. You have to have receipt for those. You cannot just say, I put the implant $5,000. I have no proof on that.
Enough?
Huh?
Is a credit card statement enough?
Yes, and yeah, that's one way. Plus, your doctor will give you a receipt anyway. But again, 7.5% of AGI is blocking most of it. So I never had a client to use medical expenses. That was me. And believe me, you don't want to have such a client anyway. That means they're dying already. The chance is high that you never have that client next year. So it's better not to have that over there. Insulin, yes. You see, insulin is included. So, but here says over the counter. Let's read it. For Stephen Neal's cold and fever, doctor prescribed an antibiotic and an over-the-counter cold remedy. Stephen's copay for the antibiotic was $25. Okay, that's good. The insurance copay, company paid the rest. The cold remedy, $5. Only the $25 will be used. The $5 is not. Medical and dental insurance premiums, yes, they are. So expenses include insurance premium paid for medical and dental care, including amounts paid through payroll deduction at work. So if you have some deduction for your medical expenses from your work, that includes. Also, if you have contribution for charity through your work, that includes as charitable contribution. Also deductible are Medicare premium withheld from the taxpayer's monthly Social Security checks. So if there is any Medicare premium withheld, that's also part of medical expenses. What else? Long-term care insurance premium are also deductible. Long-term care, it is deductible. Self-employed taxpayers deduct for AGI insurance premium paid for months when the taxpayers and the taxpayer's spouse, if married, is not eligible for an employer medical plan. So self-employed taxpayers, they don't put medical expenses in itemized deduction. Okay, social. If you have self-employed taxpayers, they go in form 1040. Let's look at that. Those I think Schedule 1. Here, Schedule 1. Let's check Schedule 1 to be sure. Additional income. Here. Line 15, which goes eventually in Form 1040, Schedule 1, that I was showing you that line. So, no, not that one. This is self-employment tax. Okay, that self-employment tax, since we are here, it's good to know, or at least review it. Self-employment tax, when you do Schedule C, you have to pay half of the complete Social Security and Medicare taxes, which is self-employment tax. We call it FICA. And because you paid the complete portion, that means you are the employer of yourself, right? So as an employer of yourself, half of the Social Security and Medicare, employers normally pay, and they use it as a business deduction, right? Payroll tax expense. So the same concept is here that says, okay, deduct half of that FICA tax, Social Security and Medicare, that you paid for yourself here from your income. That's what it is. So I'm not looking at that one. I'm looking at line 17 right now. Okay, line 17 is the one that right now I really want to emphasize. That is the self-employed health insurance deduction. So I want you to be careful and listen carefully. If you have a client with the Schedule C, and he said, okay, this is my, let's say, I don't know, my advertisement expense, my utility expense, whatever. But when they give you the health insurance expense that they paid for themselves and the family, don't get excited and put that in the Schedule C. That item is not in the Schedule C. That item for health insurance expense premium that they paid as a self-employed goes in Schedule 1.
Okay, so anything health does not go into Schedule C?
Huh?
Anything that's health, medical, doesn't go to Schedule C?
Health insurance premium doesn't go to medical Schedule C.
Okay.
Schedule C is just for regular income for the business and advertisement expense, supply expense, insurance expense, you know, those automobile mileage expense, those type of things, but not health insurance. Health insurance for the self-employed, including health insurance for the family. Because he's self-employed, like, who's gonna pay for health insurance? Remember, health insurance is normally paid by employer, right? So here the employer is himself. So the employer, self-employed person will put that in Schedule 1 and use that as so-called business employee benefit expense, which we call it here self-employed health insurance deduction. Make sense? So very important and common things that you might make a mistake by putting this in the Schedule C. You never put that in Schedule C. Okay, so what else is here? Amounts that are not, okay. Amounts that are not deductible as a medical expense includes premium paid on medical portion of auto insurance, life insurance, and premium paid for insurance that covers lost earning or loss of limb or sight. That is, I believe, something like, what's that insurance that you might buy in case you lost earning?
Oh,
What's the name of that?
for lost earning,
Yeah,
like a separate policy that you buy. You're not-
yeah.
Like I was thinking you meant
There's a
disability, but.
good common name for that. There's an insurance company is doing that. I forgot the name. But anyway, any type of insurance for those purposes will not be a medical expense. And taxpayer also cannot deduct insurance premium. Employees pay on their behalf. Okay, so insurance premium is not going here. Insurance premium goes where? I just said, goes in as a self-employed. Insurance premium goes in here. Line 17, Schedule 1, and then from there it goes into line 10, Schedule 10, 1040. Schedule 1040, line 10. Make sense? Okay, looks like we are good. Yeah, other medical expenses paid to doctors, dentists, hospitals, MRI, X-rays. Yeah, those are all included. Cosmetic surgery, there you go. That's normally your client will show up showing you a big cosmetic surgery bill. That is not a medical expense unless it is necessary for a medical reason. Yeah, personal vanity is not deductible, right? Medical cosmetic surgery for personal reason is not. Nursing home care, depending on the condition of nursing home resident and type of the service offered by the home, the entire amount paid to the facility may be deductible. When the main purpose of the stay relates to medical conditions, taxpayers deduct all expenses, even the cost of food and lodging. Some conditions that qualify for 100% medical treatment include Alzheimer's disease, paralysis, alcoholism, drug, physical injury, handicap, those type of things. If the main reason for living in the home relates to personal care or family convenience, the taxpayer deducts only the amount paid for medical expense. However, amounts paid for qualified long-term care are deductible when such services are required for people. Yes.
Oh, I guess going back to the vanity part, I guess dentures and like veneers would be deductible.
No dentures, you need it. Otherwise, you cannot eat.
But veneers not.
For
The teeth?
teeth?
Yeah.
Yeah, anything. Like-
Depends on why you're getting it.
Like correction of teeth,
Yeah, I guess so. I mean,
you can kind of go through that without too much trouble. Because still is dental and you can
yeah, because
you can argue that it's a necessary to do because kids are going.
Well, it also keeps your bikes aligned and stuff like that, like if you have ones that are different lanes, like the bike can change, yeah.
That's dental.
I'd make
I
an
haven't gone through the
argument.
experience myself.
That's dental.
But,
But if it is cosmetic surgery to look beautiful,
Yeah,
then
yeah.
that's not, yeah. Okay, school for handicap, that's also included. Amounts paid to send a mentally or physical handicap, yes, that's included. Travel and transportation. Okay, let's talk about that. Taxpayers can deduct the cost of traveling to medical places. That's good. That's included. This includes the cost of bus, train, airlines, taxi fares, rental cars, ambulance, those type of things. The travel costs for nurse also are deductible when paid to accompany a sick person because they are not able to go alone. This rule also applies to the travel costs for parents when accompanying a sick children. When overnight travel is required, the code limits the deduction for lodging to $50 per night each person. So you can go to a fancy hotel, but it's $50 per night per person. The cost of meal while traveling for medical reasons is not deductible. Remember, meals you need to eat no matter what, so it's not deductible. Taxpayers who use their personal car in seeking medical care may use either standard mileage rate or the actual cost to compute their medical deduction, which I suggest use standard mileage, but you have to have a log, shows exactly what time, what date, from where to where, and how many mileage. For 2022, the standard mileage rate for medical expenses is 18 cents per mile, and that is changing every year, sometimes twice a year. Sometimes first 6 months is different, second 6 months is different. So you have to have a very good recording of that medical mileage because you have to sometimes calculate it's falling in what area. Here says the standard mileage rate is easier to use. When choosing to use actual expenses method, taxpayer may deduct only out-of-pocket expenses. Taxpayers must keep a log showing the mileage and the expenses as well as receipts for items paid. So far, so good, right? Capital expenditures, home improvement and special equipment installed in a home may be deducted when prescribed by a medical provider, like a ramp. Three common improvements are swimming pool, air conditioners, and elevators. When the improvement increases the value of home by more than the cost of improvement, no medical deduction is allowed. So if you put a pool and the pool is increasing the value of home, then you cannot deduct. But if that pool is over the surface pool, like one of those you buy for $300-400, because doctor says you have a back pain and if you have a swimming on a daily basis, it will help your back pain. Okay, that $300 over the surface pool can be deducted.
Those things are so small.
Yeah. Again, all we are talking about, it has to be above 7.5% of AGI, okay? So we are talking about it, but it's hard to get to that level. But you need to know as a person who does taxes, you need to kind of be aware of these type of things. In case you are not sure, obviously you double check, but overall you need to know this.
What if you already have a pool and you get, how like some of the pools at the gym or hotels, they have that seat next to the pool for handicapped people to be led down into the pool? What if you got that addition to your pool to help you get into the pool? Could you
Then
do
it's
that?
medical condition, yeah. Yeah. And that's not gonna add to your home value anyway.
Yeah.
No one wants to have a handicap
Right, exactly.
ramp in his pool. That will actually reduce the value of your home. But overall, yes.
So then what would be the steps for you to go about valuing the house if you have to go get it? They're listed at your house? And then
It's kind of easy if you have a home, let's say, you can go to Zillow and see how much that home value is right now. And then easily think about it. Now you have a brand new pool in that house that you spend already $50,000 on that.
Yeah.
So that means your value of your home instantly goes up by $50,000.
What paperwork would the IRS want to see?
Get a Zillow. Say, see my home, which has no pool, Zillow says is $500,000. And because I put a pool, the value goes up. If the value goes up, it's not a deductible item anymore. So IRS says, immediately says, okay, you put a brand new pool, good for you, value of your house goes up. So
But in the following example, there's a difference. I guess we didn't get to that, but.
like example 3,
Yeah.
Let's read it. Under doctor prescription and medical condition, the Niels pay $7,000 for a hot tub. Oh, okay. So hot tub is kind of over the surface hot tub probably. The hot tub increases the value of home by $4,000. The Niels can deduct the $3,000 different. So your home value goes up a little bit because of that. You might say, okay, not that much. Let's say just $4,000. Then you can deduct the remaining as a, not deduct, but count it as a medical expense. But again, it's gonna help you if your AGI is not satisfied. 7.5% doesn't matter, right? So end of the day, I don't see any way you can put this over there because you're not gonna reach that 7.5% anyway. Yeah, but an argument of an example here it is, yes. An exception exists for improvement that makes it possible for physically handicapped individual to live independently. Example includes constructing ramp. So that is 100% medical expense. Widening hallways and doorways and wheelchair use and those type of things. So yes, that will be a deductible. And let's keep going. There are some prescription examples here that you can read if you like, but we're not gonna hopefully spend time on this. This is your reading for next after class. State and local and foreign taxes. Remember I said don't put foreign taxes in here because it's not gonna give you benefit. So if you have foreign tax, I think you put it in Schedule 1, right? Somewhere here. I don't remember where was that, but foreign taxes. In one of those schedules, anyway, you put foreign tax. So don't put it in itemized deduction. State and local taxes, yes. Individuals who itemize deduction include certain state, local, and foreign taxes in the calculation. There is a limitation, of course, right? The 10,000, remember? No. Yeah, state local tax or income tax. And then eventually it will end up by $10,000 limitations, yes. So the tax law limits the type of taxes that are deductible. Property taxes qualify, yes. But only when levied by an agency other than federal government, like state government, right? Qualifying taxes must meet two conditions before a deduction is available. First, the taxpayer must actually pay the taxes. So if you don't pay taxes, it's not gonna count. Second, the taxes paid must be those owed by taxpayers. Amounts the taxpayer pay for someone else's taxes cannot be deducted. So you cannot pay a property tax, state local tax, let's say, for someone else and count it towards yours. Other deductible taxes include federal income tax, FICA, Social Security, Medicare, federal and state gift or inheritance taxes, use and excise taxes. Use taxes are charged for using some type of properties in a business. Those type of things, they charge you use tax. Taxes imposed on gasoline, tobacco, alcohol. The remainder of this section describes the type of taxes that can be deducted and itemized deduction. So general sales tax will be calculated by the software itself. Then you compare to local income tax that you pay, whichever you can choose, check the box and see the difference and choose the best one. Taxpayers have the option deducting either state local tax or general sales tax. The deduction by individuals for state, local, and foreign property tax and the states and local income taxes and general sales taxes paid or accrued during the tax year is limited from 2018 until 2025 to only $10,000. Taxpayer who itemized checkbox 5A on Schedule A if they choose to deduct their general sales tax. So if you choose that, you have to check the box to use general sales tax. They can enter the amount of their deduction, either state and local taxes or general sales taxes on Schedule A. We talked about that already. Here is the sentence that it says, if you are living in a state like California, that you are paying high taxes, you might find out that your local income taxes are higher than your general sales tax calculation. There are three ways of paying state local income taxes. These are through W-2 paycheck withholding, which shows at the bottom state income tax, by making estimated taxpayer payments in the current tax year that you pay quarterly, by paying additional taxes excluding interest and penalties for the current or previous year. So those are three ways that you might pay state income tax. So NEOs are subject to $10,000 deduction cap for taxes. They enter $10,000 on Schedule A. So even though they paid state income tax $10,400, estimated tax of $2,400, state income tax with 2021 return filed in April of 2022, that's $175. Additional tax assessed on 2020 state income tax paid in May of 2022. Combined is $13,000, but it's subject to $10,000 max. Okay, here is the thing. It says taxpayers compute, be careful here. Taxpayers compute their general sales tax, if you want to use it, using either actual sales receipts or by estimating their amount using the IRS table. So if 1 year you buy a brand new car, $60,000, and you pay $6,000 of sales tax, you're gonna probably use that. But let's say you didn't buy a car, you just use the IRS provided table, which software will calculate and says a person with income in your limit, they put something in that box for you. So you have to choose either this or that, not both of them, okay? The IRS provided sales tax table use the tax rate of the state where the taxpayer live. Taxpayers available income and the number of exemptions claimed by the taxpayer. So they kind of look at how many dependents you have, how much income you have, and which state you are living in order to calculate that. When using the IRS table, taxpayers add to this amount any sales tax paid on motor vehicle, boats, and aircraft. Okay. Let's okay. This is a good news, actually. When using the IRS table, taxpayers add to this amount any sales tax paid because you bought a car, a boat, an airplane. That means you can use the general tax, sales tax, plus this sales tax that you pay. So it's good. It's not either or.
Buying, like usually, people get a loan to lease a car, in which case the tax is probably spread out over payments, right?
You can use just that as a sales tax, yes. So you say, I paid $30 sales tax for my lease times 12, that's $360. Then you add it. Okay, let me show you I'm just thinking why we have two highlights here. At the top, it says, let's say you go to grocery store and you pay $300 for grocery and you pay, I don't know, $30 of sales tax, and you keep the receipt. That grocery, yes, I know it shows the sales tax, but you cannot say, oh, I have all these receipts, plus I'm going to use IRS table. The moment you use IRS table, then those receipts are not important for grocery, and then you bought a pizza, and then you bought supplies for your school. Those are not, you cannot combine them. However, if you bought a big item, then you can use the general sales tax plus the big item that you bought. The big item includes motor vehicle, boats, and aircraft.
Doesn't include computers. Like computers should be on them.
No, because computer is not big item. Computer is same as supplies that you buy, which again, you can say, no, every single receipt I want to have it. It will be more than IRS general table. Then you're more than welcome to do it, but no one is doing that. So you use IRS table, you forget all your small receipts. But if you have a big item like motor vehicle, boats, and aircraft, then you add it to it. There is one more thing that you can pay. I'm just wondering. Yeah, you can add to this. I think this is the place you add it. It is the registration. When you register your car, you get a form from DMV. In that form, there is a tax for your registration license fee that it says may be tax deductible. Right next to it, it says may be tax deductible. Like $30, $10, $80, something like that. So that portion in the car registration. So if technically when you get car registration form, pay whatever it is, so you get your car registration. But that paper, put it in your tax file because you want to use it maybe in your itemized deduction, maybe. But again, if itemized deduction is big enough. And in case the client says, I don't know where that paper is, the registration paper, then tell him, go get me your registration from your dashboard, because it has license plate and it has the VIN number. Then go to DMV website using VIN number and license plate. You can see how much is the tax deductible. Let's say $10, $30, $100, whatever it is. It's not a big number, but it is better than none. It will be in here. It says other taxes. Yeah, it will be in here. That you put a vehicle registration fee or tax. You put it here as a line item. If you have 3, 4 vehicles, each you paid something, and it's tax deductible, and you can add it in here. Okay, let's talk about refund of state and local income taxes. A refund of prior year's state or local income taxes does not reduce the amount of tax paid during this year. Instead, when the refund stems from taxes deducted in a prior year, that means if you did itemized prior year, the amount is reported on Schedule 1 as income. You call it taxable refund, credit, or offset of state and local income taxes. Just say taxable refund. In accordance with taxable benefit rule. So Schedule 1, I have it here. Here, line 1. That's where it goes. Okay?
Why do they look at the prior year?
Isn't that BS because it's money that you overpaid them and now they're taxing you on it as income?
Yes.
It's your own money.
Yes.
They're giving you back.
Okay, let me show you in Schedule A. Okay, in Schedule A here, let's say in 5A, you put that I paid $15,000 or whatever to state and local income tax. Let's say 5,000. I paid $5,000 to state and local income tax. And you are getting a benefit out of that, right? IRS says, okay, you show me that you paid this much and you are getting a benefit filing federal tax return. Now, 2 months later, you got a refund of $500. That means that 5,000 that you put it over there was not 5,000. It was 4,500, not 5,000. But you put it 5,000 and you file your taxes and you claim that. It says no problem. The $500 that you got a refund and you itemized it in this year, the next year, please put that $500 in Schedule 1, line 1. So your client will get a 1099G. 1099G.
Is it G for government?
Huh?
Is it G for government?
Yes, 1099G from your state government. You're gonna get that. And they're gonna bring it to you. And you're gonna say, oh, this is your state refund. Let's say $500. But the first thing you say, let me see your last year tax return. If last year tax return was not itemized, guess what? You don't need to put that $500 refund anywhere. But if you did itemize last year, now that $500 will become taxable income for federal purpose. And for federal purpose only, not state purpose. that means in your state tax return, that $500 will not show anywhere.
I still don't understand why they're doing that.
Here,
Because if you pay taxes on money, like if I pay tax, even though I'm itemizing it, I still pay those taxes after I've already paid taxes on my income. To me, it sounds like it's double dipping. Like if I get paid from my job, they've already taken money out of the taxes out of my income.
state of California.
Both federal and state.
No, let's focus on state.
Okay, but state. And then I go and I buy all of this stuff, and then I'm itemizing and I pay more taxes. So I don't understand why.
Okay, let's focus on state of California. Let's say state of California withhold $5,000 from your income, right? So you paid state taxes, right? $5,000. So you go to federal government and say, hey, federal government, in your Schedule A, I want to show that I paid $5,000 to the state of California. And because of that, I'm going to reduce my income. And because of that, I'm going to pay you less taxes.
Okay.
Then federal government says, no problem. I agree. You paid $5,000. You are entitled to put it in here and bring your income down and pay me less taxes. But then 2 months later, when you get your state refund, or a month later, of $500, then IRS says, wait, remember you put $5,000 over there? Now you got out of that $5,000 that you told me you paid, you got $500 back. So you didn't actually pay $5,000. You paid only $4,500, but you put $5,000. Job is done. Case is closed. So hold on to that $500 refund. Next year, go in Schedule 1 and put that $500 that you have a refund and you got a 1099-G from the government of state of California. Put that $500 right in here.
But if they don't send the 1099-G, you don't have to put it there.
You cannot say, oh, they didn't send it or I didn't receive it. You know that you received a refund of California $500. You know that for sure, right? You know that. So you cannot claim, oh, because 1099-G got lost, that's why I didn't put it in here. Still, you are responsible to put that money in here. But normally, as a reminder, you get a 1099-G anyway. But if you didn't itemize last year, which most of the time that's the case, then that 1099-G doesn't matter. Doesn't matter how much refund you get from state of California. It's not going to be anything in line 1 in year because you didn't itemize last year. Okay, so real estate taxes, this is a little bit tricky. So let's get to it. For example of tax, there's another example here. You can read this. That's regarding a state income tax refund. So you can read that. Okay. The tax law in regards to real estate, the tax laws allows individuals to deduct from AGI ad valorem taxes that they pay to state and local government. Ad valorem taxes are taxes imposed on the value of the property. Local government levy real estate taxes on the owners of real property based on the property's value. Therefore, the owners can deduct state and local real estate taxes as an itemized deduction. They also can deduct real estate taxes paid to foreign governments. This deduction, which includes all state and local income, sales and property taxes, is limited to $10,000 right now. So real estate taxes are deductible that you pay property tax, but again, it's limited to $10,000. When real estate is sold during the year, the seller is responsible for the real estate tax up to until the day of sale. The buyer's responsibility starts on the day of the sale. Real estate taxes are normally assessed once a year. The tax bill is sent to the property owner. The tax law allows taxpayers to deduct the expenses that they both pay and are responsible for. Okay, so that's real estate property tax. Let's continue. Yes.
What did it say, what did it say 5,000 for married joint?
Remember I said if you do married filing jointly, so many things goes wrong for you. That's one of the things. Yeah. That's why I didn't count what. I said so many things gonna be bad. And every time we go forward, we see a scenario that married filing separately will.
What's it separate? Oh, the jointly. I thought I read that.
It's said separately, right?
This is separately.
Separately? Oh.
Yeah,
Yeah, okay, yeah. I thought I was confused. I got it.
yeah, separate, yeah. They're gonna penalize you because of that, yeah.
But that's also because you're both claiming 5,000 then, and you're still getting. I mean, it's not, I don't think it's a complete.
Because people normally, who wants to do married filing separately? People who try
Like it was a
to,
minimal difference.
people who try to pay less taxes. They say, they think they are smart and they are trying to do this way because husband has a lot of income, wife doesn't have that much income, and they try to manipulate the system. That's why IRS will impose this type of things as many times as he can. Okay, so what's going on? Okay, here in this example says, depends how many days you have the property, I believe, then you are responsible for that property tax. So you have to calculate how many days in that year you were the owner until you sell the property. So on May 11, 2021, Jill sells her home to Ryan for $200,000. Real estate taxes on the home are expected to be $3,000. At the closing, Jill pays Ryan's $1,068. So Jill sells. Jill is the seller, okay? At the closing, Jill pays Ryan $1,068, which is 130 days out of 365 because it's sold in May. This amount is her share of real estate taxes for the 130 days she owed to the home during 2021. In turn, Jill deducts this amount as a real estate taxes on Schedule A in 2021. At the end of the year, the local government sends Ryan the tax bill. Ryan is the buyer for 2021. Although they will pay the entire amount due, Ryan's out-of-pocket cost will be the amount paid minus $1,068. So Ryan will pay it, but minus $1,068 is his deduction. Okay, good, I believe. There's another example here. Personal property tax, that is about taxes that you pay for personal property, like a boat, RV, camper, those type of things. So real estate is not the only type of property where a property tax is imposed. Some states levy taxes on personal property that is not real estate. Examples of personal property business might own includes automobiles, trucks, office furniture, and machineries. Individuals can own personal property like what? Individuals can own personal property they use in their personal lives or hold for investment. This would include clothing, home furnishing, artwork, and share of stock. But I don't think we are paying a personal property for those type of things. It should be a big item to be taxed as a personal property. Unless it's for investment. So let's see an example. Niels paid the Department of Motor Vehicle. Oh, this is the one that I was referring to. 717 for annual cost to register their two cars. The fee includes a $50 tag renewal fee. The rest of fee is based on the value of the car. The NIL reports 667 as personal property tax on Schedule A. So that vehicle, again, registration fee that says may be tax deductible in the form that you receive, that's what it is. It says on the form, so DMV website has also the number for it. You can use your license plate and VIN number to find it if you lost the form. So personal property goes in, if I have a Schedule A here somewhere. Here, personal property, state and local personal property tax, that's where you put it in here, 5C. Remember previously I said 6, it goes in here? No, it goes in personal property tax, 5C. Okay, good? Other taxes like foreign source of income, if you pay taxes, you can put it in itemized deduction, but I suggest not to put it. It is better to put in schedule, I don't know, it's 1 or 2 maybe, or 3, maybe schedule 3. Let me see. I always forget that. Yes, schedule 3, line 1. That's where you need to put it. Okay? That's the best place. Don't put it in here. In itemized deduction. Interest on non-business debt. Most personal interest is not deductible. So if you pay interest on your credit card, I don't think you can put it here. However, home mortgage interest, points, and investment interest may qualify as itemized deduction. In contrast, interest on student loan is not an itemized deduction. So eligible taxpayers deduct student loan interest on Schedule 1 for AGI. So if I have a Schedule 1 here, that is Schedule 1. That's where student loan interest goes, line 21. You're good? Not itemized deduction. Student loan has its own place. Home mortgage interest, it is, let's read it. It's good. All of them are good. So taxpayer deducts interest paid on qualified home loans, which includes debt on the taxpayer's principal residence, like main home, plus a second home. Okay? The second home, it might be a vacation home. Maybe a mobile home, like an RV, as personal home. So interest on, if it's a boat, sometimes boat and motor homes qualify as well. To take the mortgage interest deduction, then one paying the interest must also own the home. Motor homes are included because they have kitchen. And if it's a boat and boat is big enough to have a kitchen, then it will be considered as qualifying second home. Make sense? To take mortgage interest deduction, the one paying the interest must also own the home. Yes, sorry. Persons who own 3 or more homes can deduct the mortgage interest paid on only their main home. Plus, they have to choose one other home of their choosing. Okay, so 2 homes max. The second home can be a motor home or a boat with a kitchen. When allowing others to use a home, the home will qualify as second home if the taxpayers use the home during the year for more than greater of 14 days or 10% of total days rented. So that will be a second home if they use more than 14 days. The NIL makes mortgage payment on their main home and their vacation home. The interest paid on these properties was $13,000 and $3,220 respectively. The NILs deduct $16,000, the combination of those two, as mortgage, home mortgage interest on Schedule A. Okay, this is the part that it gets tricky. One type of qualifying home interest is acquisition home indebtedness, which is purchasing of the home, right? This includes money borrowed to buy, build, and substantially improve the taxpayer's main or second home. Only the interest paid up to $1 million of acquisition debt can be deducted. $500,000 for married filing separate. This limit reduced to $750,000 for mortgage acquired after December 15 of 2017. So it was $1 million as far as I remember, but then after that Trump tax law, Job Act and tax law, something like that, whatever they call it, TCGA or TGCA. Anyway, that changed to $750,000. No interest deduction limits exist on debt incurred before October 13th of 1987. So if it's hard to find someone that late, but if it is, there is nothing deductible. Okay, so bottom line, if it's a loan after December 15, 2017, that is $750,000 limitation. If it is before that, $1 million limitation. Make sense? So if let's say if the house mortgage is $2 million and they bought it before 2017, $2 million, you cannot deduct the whole interest. You have to divide it by 2 because 1 million is maximum. Okay, are we good so far? So let's hold on to this point. Yes.
What about rental properties, mortgages on rental properties?
Yes, rental property is an income property. It goes in Schedule E. And because of that, any interest or any other expenses you have, it is on Schedule E, including depreciation.
On rental income, it's Schedule E?
Yes, everything is Schedule E.
Right.
Rental income, depreciation of rental income, interest of rental income, maintenance of rental income, everything will be on Schedule E. Yeah, don't mix it up. We are talking specifically for your home and your second home, like a vacation home or a motor home, something like that. That's about it, nothing else. So let's stop here. That's good enough. We don't want you to learn too much.